I'm making this video to help beginners in the stock market, and this will be so helpful to a lot of people. Today's video is a stock market for beginners video about dollar cost averaging in and out. So here's the situation. When you're buying stocks or when you're looking to buy stocks, you want to buy low and sell high, right? So when you see a good stock fall in price, a lot of people get excited because they see a buying opportunity. Most people, when they see that happen, a good stock falling in price, they want to buy, and they want to buy right now. Now. But what's the fear and what's the danger? I mean, we've all been here. The fear and danger is that when you buy right now, the price will continue to go down. And if that happens, then you'll lose money, you'll feel bad, you'll get anxious, and you'll keep checking your phone constantly. So let me solve this problem for you. Let me give you a two-part solution. And the first part is that you need to reduce the size of your purchases. You need to get your sizing correct. So I personally would not make any one stock more than 10% of my stock market portfolio. No matter how much you love the stock, no matter how revolutionary that you think that company is going to be, just don't do it. Don't go more than 10% of your portfolio. I would say spread your risk. Spread your risk. I'm sure that you can find 9 other stocks, 9 other amazing companies that you think will be just as awesome as the one that you're looking at or the one that you found. You just have to do a little bit more looking, and I assure you that you will find them. And trust me, for your emotional health and for your financial health, it will be better that you have your money riding on 10 stocks instead of just one. If you have one stock, so just look at it like this. If you have one stock and the price of that stock does nothing, it's going to drive you nuts. You're going to be disappointed every time you check your phone, every time you check the price of your stock. You're going to be like, oh, nothing happened. Oh, like I'm still not rich yet. If you have 10 stocks, I guarantee you something is going to be popping off every week. Something's going to be going down, and you're not going to be going stir crazy. If you have one stock, okay, God forbid that stock goes down. If that happens and you have one stock, then it's going to be soul crushing. If you have 10 stocks and one of them goes down, then you will not be devastated. So trust me, you're going to get a lot of financial and emotional benefits by diversifying your portfolio. And you have to, I would say that, this is where most investors go wrong because they can't control their emotions. You need emotional discipline to become a successful investor because the markets are going to be irrational, and your emotions, they will be tested. And when you get emotional, it's going to cloud your judgment and you can do very stupid things. So listen, a 10% max allocation, that is not a golden rule. Some investors will go at 5%. Some will even go at 3%. Other investors will go at 15%. All I'm saying is that you just don't want to go all in on one stock. Yes, you're going to hear those the glorious stories of people that went all in on one stock and they hit it big. But you're not going to hear the other stories of the people that went all in on one stock and they missed. Those are the stories those are the untold stories of sorrow and regrets and misery. I don't want that to be the story of your financial life. Okay, so I said that there are 2 things. The first part was no more than a 10% max allocation to one particular stock, right? Next, so the second thing is that when you're buying a stock, you want a dollar cost average in. You want a DCA, dollar cost average. So let's just say that you have $10,000 in your stock account, your stock portfolio. And let's say that you want to allocate $1,000 to SLV, which is a play on silver. Okay, the price of SLV right now, this is just an example. So the price of SLV right now is at $20 a share. You have $10,000 in total, and you want to buy $1,000 worth of silver, 10% allocation rate. So do not take that $1,000 and buy SLV all at once at $20 a share. Don't do that. I would say rather you should dollar cost average in, DCA in. So what I'm saying is take that $1,000 to buy up SLV little by little, not all at once. So for example, pick up $400 worth when it's at $20 a share. If you buy it at $20 a share and it just shoots up and it never looks back, it never comes down, then great, you made money. If you buy it at $20 a share the $400 worth, and then it falls to $19. I would say buy another $300 worth. And at that point, if it just shoots up, if it skyrockets up, if it never goes down further, then that's great. Then you made money. If you bought it at 20 and 19 and it falls to 18, then buy another $300 worth. And at that point, you will have deployed your full $1,000. But now, by doing this, you are now averaged in at approximately $19 a share. And you're much better off than if you were just to buy it all at once when it was at $20 a share. So this is good, and you should be happy. Now, I want to tell you about this because this is something funny that'll happen. And a lot of people that do this, they'll agree. They'll completely understand where I'm coming from. So if you buy your initial batch at $20 a share, a part of you will actually be rooting for the stock to go down, for the stock to go down further, because that would be an opportunity for you to purchase more at a better price. So I'll just say this. When you dollar cost average in, if you make your initial purchase at 20, you're not going to be going crazy if it goes up or down 50 cents. Because if it goes up 50 cents, then you're going to be making money and you're going to be happy. If it goes down 50 cents, it's going to be closer to another buying opportunity at an even better price. So you're going to see this as a win-win situation. So listen, you are not going to be able to get precisely the absolute rock bottom price when you're buying, and you're not going to be able to precisely get the absolute pinnacle, the absolute top when you're selling. But this way, by DCAing in and out, you're going to be able to get close to it with a systematic approach. And this is going to be a game changer for most people, especially when you're selling your stocks or your cryptos. So it's going to be the same concept when you're selling. And this is something I've noticed. I've noticed that cryptocurrency investors, they've learned this a little bit faster, and they've taken this more to heart compared to stock market investors. But first, I know there's a lot of overlap here. I know there's a lot of people here that invest in both stocks and in cryptos. But okay, I'll get to the cryptocurrency parts. But first things first, you have to sell the top. There are economic cycles. There are bull markets, there are bear markets, there are cycles. Yes, the timing and the volatility of different markets will be different, of course, based on what you're talking about, whether it's silver or gold or oil or growth stocks, S&P 500, Bitcoin, whatever it may be. Different markets will be different in terms of their fluctuations and the timing. But the reason why I'm bringing up cryptocurrency investors is because I think that they've learned the hardest and they've learned the fastest through experience. You can ask any cryptocurrency investor from 2017. A lot of them got rich in 2021 because they knew when to sell. Hopefully, people from 2021 learn next time for 2025. It's very unlikely that you're going to sell the absolute pinnacle, the absolute top. But when you do sell, you want to stagger out in batches. You want to dollar cost average out. So what I'm saying is that if you think Bitcoin is going to $100,000, let's just say that the top end or the range of the next bull run, $100,000 in the next bull run, then I would say get your sell orders in starting at 80,000. 80,000, 90,000, 100,000, maybe save a little bit of an order for 105,000, for example. And you know what? If Bitcoin shoots past that, if it shoots to $120,000, I would say who cares, because you made so much money. And anyways, and besides, you know that it's going to come crashing back down from $100,000 to $20,000. You know that. So if it only hits $90,000, at least you got to offload the bulk of your position near the top. By selling out in batches, you are reducing the chances that an all or nothing event goes badly against you. So for example, if you put a sell order in to sell all your Bitcoin at $100,000, but it only reaches $90,000, and it crashes back down to $20,000, then that's going to be pretty rough for you. So what's the moral of the story? The moral is to get rid of the all or nothing approach, to get rid of the all or nothing mentality. Go big or go home. Instead, dollar cost average in and out. And by doing so, you're going to reduce your emotional damage and you're going to become a better investor. You may think that I'm oversimplifying this, that this sounds too easy, this sounds so easy to do, but trust me, it's not. This is actually harder than it sounds. That's because if you want to DCA in and out, it requires patience, which is very lacking among a lot of investors these days. It requires discipline. But I highly encourage you to start utilizing this dollar cost average approach on your purchases and on your sales. And I want you to be aware of this because this is very important. So you can use this staggered exit approach in many ways. For example, I made this clear. I have Exxon stock, XOM. A lot of people ask me when I'm going to sell the Exxon stock. I think that's a very good question. I'll most likely sell Exxon when it becomes overvalued, when it runs up too hard, too fast, more than it's justified. So when will that be? One scenario of multiple. So one scenario is that if oil shoots up to 130 a barrel to 150 a barrel. Listen, if the price of Brent crude oil gets to $130 a barrel, then I'll start selling off some of my Exxon stock. If oil gets to 140 a barrel, then I'll sell off some more. If oil gets to 150 a barrel, then I would be completely out of my Exxon position. Because if oil gets to 150 a barrel, investors would FOMO into oil stocks, they would FOMO into Exxon, they would drive up the price. But oil at 150 a barrel, that would be unsustainable. Oil would come down and Exxon stock, it would fall back down accordingly. So you can use an underlying asset, an indicator, or an index to determine how you will dollar cost average out of a stock. So I'll give you another example. Let's say that you have Ethereum or Cardano or Dogecoin or whatever altcoin. You can have a strategy that you're going to start selling your altcoin positions when Bitcoin, so you're going to be tracking Bitcoin, when Bitcoin hits 80,000, 90,000, 100,000. Because if you buy Cardano right now, and you say that you're going to sell Cardano at the peak of the next bull run and you're not paying attention to Bitcoin, then you're going to be in the dark in terms of what prices to be staggering out of Cardano. So you see what I'm saying? So just keep that in mind. And you could do the same thing with the S&P 500 or the NASDAQ when you're looking at individual equities. So when you're dollar cost averaging in or out, I'm just saying that you could look at it from a bottom up approach, or you could look at it from a top down approach, or you can look at it from both perspectives. I hope this has been helpful. Please check out our Patreon website. We have exclusive content on stocks and investing. It's a great place to learn. I'll leave a link down below in the description of the video. Thank you for all the support, and I wish you a very nice day. Please take care.